Hello and welcome to Amberger Smackdown. I'm J. Christoph Amberger. Whenever you turned on the television or the radio these past couple of months, you'd have been hard-pressed not to stumble over some airhead commentator sermonizing about supposed credit crunches, the mortgage debacle, and looming recession in the lugubrious tones usually reserved for memorial services held in honor of deceased Mother Superiors, perished philanthropists, or Sparky the expired Springer Spaniel. But there's the pseudo-reality that the media like to wallow in, and then there's reality, which is that credit is plentiful. Mortgages are easy to come by, unless you just pawned your grandmother and gotten evicted from her retirement home efficiency you illegally occupied. And contrary to what the talking heads tell you, very few people did indeed take equity out of their homes to blow the cash on jet skis and jelly beans, or at least they stopped doing so 2 years ago, when mortgage and refinancing rates started to edge up and it didn't pay anymore. If you look at the numbers, there's one guy in particular who apparently has no problems getting credit at all, and certainly is not anticipating a recession anytime soon. It's the American consumer, whose spending rose more than forecast in August. The US Department of Commerce reported a 0.6% rise in spending, the biggest in 4 months. At the same time, inflation cooled and business activity unexpectedly picked up last month. And it's not graham crackers and boxed macaroni and cheese that were responsible for the increase, but purchases of cars and furniture. People expecting to eat rice-a-roni for Thanksgiving dinner don't buy cars, and they don't splurge on new sofas. But it's not just consumers spending. The National Association of Purchasing Management Chicago's Index of Business Activity rose to 54.2 in September. Even construction spending rose in August, led by factories, hotels, and offices. Are the usually parsimonious principles of these businesses suffering from mass delusions? Or do they know something that desk jockey economists haven't quite understood yet? It will take more than a few subprime loans defaulting to have an effect on American buying patterns. And as long as the American consumer keeps spending, there will be growth. Accordingly, the Shanghai Composite Index, probably the best indicator of the health of the American economy, again is closing at new record highs with daily gains of 2 to 3%. The same goes for Hong Kong. Now, I have to agree with you here. Every growth curve eventually flattens out, then falters and collapses. Accordingly, any trader worth his salt is watching Asian growth with unease. There's that unpleasant business about China's $1 trillion in bad debt, after all, its culture of corruption, its overspending on the 2008 Olympics and other frilly things. But the trend remains powerful. It is pointing upward. And more money has been lost not taking advantage of bull markets out of prissiness and overcaution than was lost in the inevitable corrections. As the Dow has once again passed 14,000 and is setting new all-time highs, the talking heads are dutifully getting tired of blaming subprime for the dip in the market that has now been ironed out of the books. And all of you who took my advice back then and considered the drop down to 12,500 a buying opportunity were able to buy the top US stocks at a 10% discount or better. You'd be even better off had you invested in China when the pundits were running from Shanghai in February. I'll be sticking to my guns and predict the Dow above 15,000 by year end. Make hay while the sun is shining. For TFN FinancialNews.com, I'm J. Christoph Amberger.